When people talk about Roth IRAs and traditional IRAs, the discussion often gets framed as a simple choice: pay taxes now or pay taxes later. In reality, the decision is much more nuanced than that. In this video, we're going to walk through how Roth IRAs and traditional IRAs work, how the tax rules differ, and what people typically think about when choosing between them. Hi, I'm Justin Kuntz, Managing Director of Pacific Wealth Management, helping you make good financial decisions through sound management for a secure future. To make sense of the trade-offs, it helps to start with the basics. Roth and traditional IRAs are simply account types. Inside either one, you can own a wide range of investments, and the results will depend on what you choose to invest in. The main difference between the two is how and when the dollars within those accounts are actually taxed. With the traditional IRA, contributions may be tax deductible depending on your income and whether you or your spouse is covered by a retirement plan at work. When a contribution is deductible, the money goes in pre-tax, grows tax deferred, and then when you take it out in retirement, withdrawals are generally taxed as ordinary income. This structure can be especially attractive if you're in a higher tax bracket today, since you'll receive a deduction now and deferred taxes until retirement. The trade-off, however, is that you're building up future taxable income. And once you hit the required distribution age, that's 73 years old right now, the IRS starts making you take withdrawals, called required minimum distributions, or RMDs. And this happens whether you need the money or not. Roth IRAs, on the other hand, reverse that sequence. Contributions are made with after-tax dollars, so there's no tax deduction up front, but in exchange, qualified withdrawals are tax-free. That includes both the original contributions and the growth on those contributions, as long as the IRS requirements are met. Another important distinction is that Roth IRAs don't have a required minimum distributions for the original owner, so you're not forced to take withdrawals at a certain age, like 73. This difference becomes especially relevant in retirement planning, since at that stage, the challenge shifts from accumulating assets to managing taxable income. Roth accounts can also provide flexibility because qualified withdrawals generally don't add to taxable income, giving you more control over how and when your income appears in your tax return. With that framework in mind, the next question is how much you can actually contribute. For 2025, the IRA contribution limit is $7,000 if you're under the age of 50 and $8,000 if you're 50 or older. In 2026, those limits increase to $7,500 and $8,600 respectively. One detail that's easy to miss is that this is a combined limit, meaning that it applies across all IRAs, whether that money goes into a Roth IRA or a traditional IRA or a combination of both. The total contribution amount can't exceed that annual limit. Unlike traditional IRAs, Roth IRAs have income limits for direct contributions. For 2026, the phase-out range begins at $153,000 of modified adjustable gross income for single filers and heads of household, and at $242,000 for married couples filing jointly. If you're below those ranges, you can typically contribute the full amount. If you're in the phase-out range, you may be able to contribute a reduced amount. But as soon as you're above that top end of the limit, you generally lose the ability to contribute directly. And this is the point where many high-income earners begin looking for alternatives, which leads to what's called the Backdoor Roth strategy. A Backdoor Roth isn't a separate type of account, but rather a specific sequence of transactions within that account. The strategy involves making a non-deductible contribution to a traditional IRA and then converting that amount to a Roth IRA. Because there are no income limits on Roth conversions, this allows some individuals to effectively fund a Roth despite their high income or income restrictions. The most common backdoor Roth mistake, however, involves the pro-rata rule. If you have any pre-tax money within a traditional IRA, SEP, or simple IRA, the IRS looks at those accounts together when the conversion occurs. You can't choose to convert only the after-tax dollars that you funded in a non-deductible way. Instead, each conversion is treated as a blend of pre-tax and after-tax money based upon the total value of your IRAs. This is exactly why Form 8606 is critical. It tracks your after-tax basis in IRAs so you don't get taxed twice. And it's a form that makes the non-deductible IRA contribution actually count as non-deductible. Overall, the backdoor Roth can be an effective strategy if you're above the Roth income limits, but only when it's used with a clear understanding of the existing IRA balances and proper tax reporting. So far, we've focused on how contributions work. The next step is understanding how withdrawals are treated. Traditional IRA withdrawals before 59.5 typically trigger ordinary income taxes plus a 10% early withdrawal penalty, with some exceptions. As mentioned, in retirement, withdrawals are taxed as ordinary income, and required minimum distributions eventually apply. Roth IRAs operate a little bit differently. Original Roth contributions can generally be withdrawn at any time without taxes or penalties. Earnings are treated separately. For earnings to be withdrawn tax-free, the distribution has to be qualified. In most cases, that means that you have to be at least 59.5 years old, and the account must satisfy the 5-year rule, which begins on January 1st of the first year you made the Roth IRA contribution. It's also important to mention that Roth conversions can carry their own 5-year timing rule for individuals who access the funds before 59.5. So it's important to keep track of each. Given all of this, the next step is looking at how to apply these rules in practice. A helpful starting point is to ask whether or not you qualify for a deductible traditional IRA contribution. If you don't, the Roth IRA becomes a more straightforward option unless the traditional IRA is being used specifically as part of a backdoor strategy. Next, consider how your current tax rate compares to what you expect in retirement. Higher current tax rates often favor traditional contributions, while lower tax rates in the current day often make Roth contributions more appealing. Many people also value tax diversification. Holding both pre-tax and Roth assets allow for more flexibility in managing taxable income later on when you do retire. Finally, if you're approaching retirement and most of your savings are in pre-tax dollars, Roth conversions can be worth exploring. Converting some assets earlier can reduce future required distributions and increase the amount of tax-free income available down the road. While these strategies can be effective when used thoughtfully, the rules around IRAs leave room for mistakes. In practice, a few issues tend to come up repeatedly. Some people contribute to Roth IRAs without even checking their income limits and have to correct that contribution later on. Others attempt backdoor Roth strategies without fully understanding the pro-rata rule, in which case they might not take the required amount in taxable income if they distribute from a traditional IRA. Another common mistake is leaving contributions uninvested after they're made. In this case, you're pretty much giving up one of the primary benefits of these tax-deferred or tax-free accounts. In a traditional IRA, money that grows and compounds on itself does so in a tax-deferred capacity, so it has the ability to grow that much faster. And in a Roth IRA, if you never get those funds invested, you give up the potential of growth that is completely tax-free when you withdraw. And lastly, in some cases, people delay action entirely because they're trying to optimize every variable before moving forward. Overall, both Roth and traditional IRAs are both effective tools when they're used intentionally. The right choice will depend on your income, your current and future tax situation, and the level of flexibility you want in retirement. For many people, the answer tends to be a combination that evolves over time and changes. Understanding how these accounts work will allow you to make decisions that support your broader financial goals rather than reacting to those rules in isolation. I'm Justin Kuntz, Managing Director of Pacific Wealth Management, and if you found this video helpful, check out our other videos or visit us on our website at www.pacwealth.com. Thanks.